So in this final part of our video on fixed income securities, we'll talk a little bit more about the global marketplace and specifically a different type of fixed income security than a bond. So let's talk about the global view. Again, obviously there is an international bond market. The challenge obviously with international bond markets is the risk, right? The impact of currency fluctuations in addition to just the changes in government economic situations. Not necessarily talking about war-torn areas or areas of severe economic downturn, but there are things out there. I mean, governments sometimes act not as good stewards. For instance, if you think about Greece, right? Greece's primary income comes from tourists. So when the tourist industry declines, then what happens to the funds of governments to run the government? And so that different type of risk level was very important to understand how the riskiness changes with respect to this foreign debt. So we can have U.S. pay denominated and federal dollar denominated debt. So dollar denominated bonds are frequently referred to as Yankee bonds, right? These are issued by foreign governments, right? But they are also traded. They're traded in the United States. They're registered in the United States. They're in U.S. dollars. And of course, since they're in dollars, there's no currency exchange risk. Now, euro dollar bonds are issued, traded outside of the United States. They're denominated in U.S. dollars, but they're also not registered with the SEC. So this euro dollar market is aimed at institutional investors for the most part. So they're dominated by these foreign-based institutions, if you will, with respect to euro dollar investments. So Yankee dollars or Yankee bonds is typically what a person from the United States, an individual, may want to buy. Now we have foreign pay bonds. These are bonds that are denominated in any currency other than the United States. They're not registered with the SEC. They're issued and traded overseas, right? So all of their payments are in that foreign currency. So they are also subject to currency exchange risk. So if you think about how you calculate the return for one of these, we have a holding period return that is based in foreign currency, and then we have to adjust that with the change in exchange rates over the time frame. So the total return, if you will, is this holding period return times the exchange rate at the end divided by the exchange rate at the beginning. This just converts, if you will, our foreign holding period return into U.S. holding period returns. Now another type of security is something called a convertible bond. And there are also convertible preferred stocks, and they all work very similar. These are usually bonds, right? They're issued by a corporation that allows investors the option to convert their bonds into shares. So essentially, this is a benefit if you're an investor and you want to potentially take advantage of some growth in the company or increasing stock prices. You may want to buy a convertible bond so that you can take advantage of that later. They have similar attributes of both debt and equity. So we really need to look at them and analyze them. First, you kind of think of them as a form of equity, but we have to incorporate the bond characteristics, if you will. So how does this work essentially? So again, these are popular because of the opportunity. I mean, they refer to it here as an equity kicker, right? It's this extra opportunity for earnings because of stock price changes. So it's going to act an awful lot like a stock, but only after a certain point, right? So to a certain point, and we'll talk about it here in a second, this is going to act exactly like debt. But once we reach this critical point, it's going to start acting like a stock rather than debt. So convertible notes are not really like convertible bonds, except that they have, are like convertible bonds, except that they have a shorter maturity. We know the difference between notes and bonds. Forced conversion, right? Although you have the right to convert, more often than not, the issuing company is going to start to call the debt if the situation turns correct for calling the debt. And of course, rather than calling the debt, you may want to convert to equity to save the equity piece and opportunities with this particular debt. So they can't force you to convert, but they can call the debt, which may cause you to ultimately want to convert the debt. So the conversion privilege, obviously, that stipulates the condition for which you to convert this debt into stock. There's a conversion period. There's a time period during which you can do this. And that's not really a time like you can do it in the first 5 years. Typically, it's a time period during the year that typically revolves around dividends, the dividend payments, and it also could relate somehow to the interest payments on the debt. The conversion ratio is the number of common shares in which it can be converted to. So you have a bond that will allow you to convert into 20 shares of stock. Well, that's the ratio. The conversion price, that's the value of the share at which the common stock would be delivered to the investor in exchange for the issue. So that is the price of the stock itself when it's converted. Now there's specific places where these things can happen, and again, just as a specialized kind of a version, there's this thing called a lion, and this is a zero coupon convertible bond, right? Again, it's just a bond, it's convertible, but in this case it is zero coupon. So again, it's just a particular type of a convertible issue. So let's talk about where the value comes from, right? Values of a convertible bond are based on both the stock and the bond dimensions, right? Convertibles trade a lot like common stock because the price of the stock is what really drives the investor's decision. The bond price acts as a floor. So that is, whatever the bond price is, that is the place, that is the floor. It can't go any lower than the bond price. However, if the stock price is rising, if the convertible price rises above the bond price itself, then the value could, the value of this whole thing could exceed the bond price. So again, the bond price is kind of like, it's the worst thing that could happen to you is you have something that's worth the value of the bond itself. So let's see how this might work, right? We have something called conversion value. It's the conversion ratio times the stock price. So if the stock is worth $10 and you can convert it into a conversion ratio, $10 times 20, $200 is the conversion value. Now the conversion equivalent, this is the price at which the common stock would have to sell in order to make the convertible security worth its present market price. So let's say that the price of this, the price of the convertible bond is $1,000, and it has a conversion ratio of 20. 20 into 1,000 is 50. So the conversion equivalent, the stock price would have to be at least $50 or more for a conversion to make any sense. The conversion premium is just the price of the convertible bond minus the conversion value. So you would never convert a bond if the conversion premium were negative, right? You want the conversion value, right? You always want this to ultimately be the premium to be positive. And of course, you can convert that to a percentage, right? So again, you're willing to pay a premium, right? Because of this opportunity for the upside potential. And of course, changing that to a percentage, you can put things maybe in a comparative sense, right? You have 4 convertible bonds to look at. Which one would you want to invest in? You would want to invest in the one that had the highest conversion premium. Again, all else being equal, you would want the one with the highest percentage. The payback period is just the measure of time that it would take for you to get the conversion premium, right? Once you convert into this into the stock. So you take that premium and you divide it by the interest income minus the dividend income, right? Because you were going to get the interest, and now if you converted it into the stock, you would get the stock. So this is just the difference between the two. Essentially, it's how long will it take for you to get this premium back. And you may set a range and say, look, unless I'm going to get this premium back in 4 years, I'm not going to purchase any convertible securities unless they meet that minimum requirement. So again, the investment value of a convertible bond, right? That's the price you'd be willing to trade if it were non-convertible. And if it were priced at or near prevailing market yields for non-conventional bonds. That's the investment value, right? You find this by discounting the coupon stream and its par value. This is just finding the value of the bond itself. Now you want to compare that to the value of converting it into the stock. Is the conversion value, is that greater than the investment value? If it is, then you may want to convert this stock or this bond. So again, we're not a lot of detail about convertible securities. They're certainly just an aspect of what we want to invest in, or things that we could invest in. And again, they are essentially kind of an equity security. So you have some safety, some security, some certainty when you buy it as a bond, but you also have the opportunity to get some upside growth. So that is the basics. Those videos are the basics of fixed income securities.